Just finished a panel, myself, Kirsten Green, and Ade from Base 10 with Tom Giles, who's the tech editor for Bloomberg Tech,
Right.
and we talked about what's going on. So, like you mentioned, we had a big slowdown last year. A lot of people put their pencils down. They're both, it felt like there was a falling knife in terms of public markets, which obviously affects the private markets. And so people said it's not a great time to be investing in private companies. I do think that we're seeing quite a pickup this year. But it's largely driven by AI, which is great. It's very exciting. It is the new hotness in venture capital. So you just have to, it can be quite treacherous, I think, to invest in AI right now. Because it's, obviously there's a lot of energy right now. We're kind of in a consolidation phase, and for very good reasons, right? Whether it's Microsoft or Meta or Salesforce or ServiceNow or Google, you need a lot of, and OpenAI, you need a lot of money. You need a lot of GPU, you need a lot of engineers, and so there's kind of this tectonic plate war going on in the big tech players right now. And so if you've got a really big fund, you could try and align obviously most of these companies are public companies, right? So it's a great time for NVIDIA, AMD to be a public markets investor, to be able to get exposure to the AI that is going to be powering, I think, most applications for decades to come. But for private markets, I think there's just a lot of money going into startups, many of whom are not going to make it.
So the thing that's interesting about this, and Brad kind of alluded to it when we were talking to him, is the idea of it's so expensive to have this processing power, to buy these GPUs.
Yeah.
And it's not as easy as 10, 15 years ago, creating an app and building a network, which was sort of what we saw venture capital support in that generation.
Yeah.
Is there a concern that you do early stage investing, you do seed startups, seed investing? Is there a concern that these companies just can't raise the capital in order to support that?
So there are large models that the big technology companies are investing in that have billions of parameters that you need billions of dollars for GPUs. We have been investing at Cowboy Ventures. As you mentioned, we're seed stage investors. Actually, our first AI-driven enterprise software company we invested 8 years ago, where they use what we call a small model, where they don't need to buy GPUs. They basically get a proprietary data set. In that case, the company's called Textio, and we basically got HR-related documents, job specs, performance reviews, and we train the AI using very situational specific parameters to basically understand how it can help people write performance reviews more effectively, how it can help people write job specs more effectively, and you just don't need the giant GPU to be able to do that work. And then also a lot of it is around how you solve the problem for everyday business users. Instead of them using Google Docs or Word, you need to figure out how would I get into their workflow, whether it's through Workday or Lattice, and how do I actually create those integrations so that the way that the AI can be in the business process of everyday people inside the enterprise. And so I think that's those kinds of business or industry-specific applications, you don't need billions of dollars to build those applications.
But is that scalable? I'm listening to you. Is that scalable elsewhere?
Elsewhere meaning
other industries, that model.
Completely. So we're seeing, I think, a lot of there's the application layer and there's infrastructure, right? So there's money going into both. At the application layer, that's where a lot of VC funds are playing right now. So and it makes a lot of sense because so many people whether it's the food and beverage industry, in hospitals, in education, people are still using pen, paper, spreadsheets. They're not actually leveraging the underlying data, and the applications they use every day are not smart. And so I think there's pretty much every industry and every application that we look at today is going to have new applications that are powered by AI. So it is a tremendous opportunity.
Okay, speaking of opportunities, I'm wondering what's more difficult in this world where cash can earn 4.5% to 5% in T-bills, okay? That's an opportunity.
Yeah.
What's harder right now? Is it harder to go raise money from investors to then deploy? Or is it harder to find the companies to deploy that money into?
We're very fortunate. We're a pretty disciplined fund. We've been around for over 10 years now. We've had pretty much the same investors, or what we call LP limited partners, for pretty much the 10 years. So we're very fortunate. And they are savvy investors who understand the upside of investing in venture capital firms, and they know it's a 10 to 15-year investment. So fortunately for us, it has definitely gotten harder, and I think in many ways it's good because it holds us very accountable. Is there are benchmarks that you have to beat to be worth investing in, and that's our job, is to make sure that we beat those benchmarks fund after fund. And also we raise every 3 years or every 4 years. So you raise the fund and then you have 3 years to basically go find some great investments. So it's gotten quite competitive in private markets. A ton of money flooded in 2020, 2021, and it's probably not going to recede. And so there's just more money chasing private companies than ever.
One thing I wanted to ask you, Aileen, is with all the attention on AI, what's being neglected maybe in the venture world, or where do you think we should also be thinking about when it comes to tech innovation?
I do think, that's a really good question. I think the big boom when interest rates were basically zero in 2020 and 2021, it brought so much attention to the venture capital and technology world that actually what we would have considered long tail markets, parking garages, like companies selling software to parking garages got funded. Like the unicorn analysis that we did in 2013 versus 2023 showed a huge difference in the amount of money that's going to industry specific software. So in the original unicorn analysis in 2013, it's quite interesting how it flip-flopped. It was 80% consumer companies and 20% enterprise software companies. 10 years later, it flip-flopped and it became 80% enterprise, 20% consumer. And in those enterprise, you've got climate tech companies, you've got agriculture companies, you've got companies serving parking garages. So entrepreneurs, especially I think since the iPhone debuted in 2007, pretty much everyone in the modern world understands the power of technology. And so if they work in a port, if they work at a nursing station, they understand how much inefficiency there is and how much opportunity there is for technology to actually reinvent the way they do things and let humans do what they do best better.
Still waiting for healthcare to really embrace technology in a big way.
Keep waiting.
Give you a chip with all my information. I'm ready to do that. I actually am.
If you need a copy of the X-ray, here's a CD-ROM for you. I'm not joking.
Earlier today, actually.
That's still the way it works.
I only have like 10 seconds. Stephen Ode speak earlier today with Emily Chang, and he was saying that the thing that he's going to tell President Biden tomorrow is that every person should have a personal doctor, and every kid should have a personal tutor, and that would reinvent both education and healthcare, and it would be amazing.
We have to wrap.